So thank you so much for coming. I realize a good chunk of you are required to be here, but thank you nonetheless for joining us. And welcome to the 5th Annual Griswold Center for Economic Policy Studies JIW Research Forum. So the purpose of this forum is, we have a couple of goals. The first is to showcase 5 excellent past junior papers from the previous year. These are all papers that are policy related, as that is the Griswold Center's mission. So all of these papers will be identifying a policy, looking at a policy relevant question. And as you're going to see, there's a large variety of topics. We're going to talk about everything from hurricanes to Medicare policy. And I want you to remember that because the JIW really is a very broad exercise. We don't want you to think that, oh, your paper has to be kind of like one of these papers. We want to actually, use these 5 examples to give you some sense of how broad the various topics for JIW can be. So there are many avenues you can take for your JIW project. So we are going to go through the talks sort of one after another, but please save up your questions. And if you have any questions about idea generation or data collection, these 5 students here are real experts in the JP process. Before we get started, I'd like to have a few thank yous. So Kelly Noonan, Sylvia Weyerbrook, and Smita Brunemeyer collaborated to develop this program this year, now in its 5th year. Dana Molina, spent, I know, a lot of time going over the talks with the 5 of you. So without Dana, this event would certainly not be happening either. So like I said, each student will speak for about 10 minutes. Save up your questions, and then we will have a Q&A at the end. I should also mention that a few JIW celebrities are here, including some past, some current advisees and advisors. And so we could also, if you have questions about that you want to pitch to the advisors, some of them are here today as well. Okay, so without further ado, our 5 JP papers, I'm going to first just quickly describe each of them, and then we'll have Ashley Fan kick it off. But Ashley's research looks at the heterogeneity in Medicare's competitive bidding programs, and Ashley's advisor was Professor Nicholas Buchholz. Antek Hasiura is our second speaker, and his research examines bank runs in decentralized finance, and he was advised by Professor Jonathan Payne. Shirley Wren, her paper looks at, investigates the distributional effects of monetary policy shocks in China, and she was also advised by Professor Jonathan Payne. Maya Satchell looks at the credit supply shocks and how that affects the decision to move homes, and her advisor was Professor Adrian Matre. And finally, Nicole Svensson examines the effects of hurricanes on the Florida housing market in flood vulnerability zones, and she was advised by Professor Swati-Bhatt. So now, to kick it off is our first speaker, Ashley Fan.
Hi guys, my name is Ashley, and my JP explored the effect of competitive bidding on Medicare prices. I first want to thank the Griswold Center for this opportunity, as well as my advisor, Professor Buchholz, as well as my AI, Lucas, for all the help they provided. And so to motivate why this question is even important, first to note that Medicare is incredibly integral to the US healthcare system. Yet every year since about 2000, the cost of Medicare has been far outpacing the GDP growth inflation. And one of these core expense drivers is durable medical equipment. And this is a broad category encompassing about 2,886 different devices, anything from commode chairs to hospital beds, all the way to respirators, CPAPs, nebulizers, prosthetic arms and legs. And so before the competitive bidding policy was introduced, Medicare's durable medical equipment prices were determined by national price floors and national ceilings set by Medicare lawmakers, and each state had very limited flexibility in deciding a price within this floor and ceiling. So what changed in order to drive this event study? In 2011, Medicare began the competitive bidding program and would eventually roll out this program in about 130 cities and their surrounding suburbs. And so what I mean by bidding program is a multi-round auction process. And this auction is a little bit unique. It determines the supplier's awarded contracts, i.e., this supplier will supply X amount of good for this price, as well as the contract price, but these things can be separate. And so what I mean by this is that suppliers win the option, but not the obligation to sign a contract with Medicare. And this contract is not awarded at the price which they bid at, i.e., the price that Medicare eventually chooses is uniform across all suppliers, and it's the median price bid that wins. And so this leads to some very weird incentives in this auction, i.e., suppliers, right, if they're faced with a price that they're unable to supply at, they might drop out, causing oversupply, undersupply issues. And so given the kind of confounding factors within this auction, it's important to ask the question, how effective is the competitive bidding program, but to ask it along 3 dimensions. And so the first magnitude of effective I define is just how much percent-wise was like a price drop from competitive bidding. The second question is, was this drop sustained across multiple rounds of auctions, i.e. multiple price renegotiations that happened over the course of the decade? And third, is there heterogeneity in this drop between various different Medicare products? And so, my hypothesis was yes, the Medicare program, competitive bidding program is effective. If you take a look at the right of the screen, you'll see that starting from 2011, and the reason why there's not one uniform price drop is because different products, different regions implemented this auction program different times, but overall you see a price decrease. However, to really answer this question, we need to be a little bit more precise than, say, just this graph. And so my research in heterogeneity, as well as an extended time frame, adds to a very limited group of papers looking at the effect of competitive bidding in Medicare. And so both of these papers found that the competitive bidding program did reduce prices from about 45 to 47%. These papers then focused on supply-demand imbalances, right, due to perhaps the fact that prices weren't effectively incentivizing enough supply. But in order to answer the questions of heterogeneity as well as an extended time frame, I used 2 pricing data sets, the Medicare DME POS data set and single payment amounts. This data then fed into my diff and diff, and I'll start first by talking about my core regression. And so this is a really classic event study model. Beta 1 is the treatment effect of the competitive bidding program, i.e., it is the coefficient on whether a region was treated in our round. And so just to kind of explain the interaction that's going on, CBA, this variable, is 1 if a certain region is part of the R round of price negotiations, 0 otherwise, and it's interacted with an indicator of whether this auction round prices were active or not. And so this effectively captures the treatment effect of the competitive bidding program. I threw in a few additional controls as well into my diff and diff. If you take a look at the beta 2 term, and this is a particularly important control I'd like to highlight, past 2016, Medicare began altering the prices of their fee schedule regions to try to get a little bit closer to what they were seeing competitive bidding. And so kind of to capture this change in the control group, I use this control, and then I add in, of course, geographic and time fixed effects. I run this regression 11 times across 11 of the most highly utilized durable medical equipment products. Also then to examine the effect of this bidding program across time, i.e., is the competitive bidding program just as effective in 2015 as it was in 2011? I run a dynamic or staggered difference in difference regression. And pretty much this is the exact same regression that you saw on the previous slide, just done X amount of years after the bidding policy was implemented. On top of these 2 core regression models, I throw in a few robustness checks, one of which is just looking at the overall effect, i.e., across all 11 products, what is the overall decrease brought on by the competitive bidding program? And then I also include, in addition to geographic and time fixed effects, what I like to call a market fixed effect. And you can think of that first term in the bottom regression as effectively being like, okay, is there something that's time invariant but very unique, say, to the bidding markets of CPAPs in Cleveland? And so I like to call this the market fixed effect. And so after running these regressions, I first to answer the question of what was the overall magnitude, what was the overall effect of the competitive bidding policy across all products. I'm able to find across all these various robustness checks about a 40 to 50% decrease, with my core model giving a prediction of about a 45% decrease. And this is really promising, seeing that existing literature has had a 45 to 47% decrease from the competitive bidding program in prices. But this is where my paper adds to existing literature, and it's looking at the results per product and per product over time. And what you'll see here is a very interesting split between 11 of these highly utilized products, i.e., you have this cluster of products, these low effect products, which have a treatment effect of around like 10% price drop. And then you have these high treatment effects of these various products that seem to have nothing in common with each other besides that they have a price drop of around 50%. And if you look at the staggered diff and diff I was telling you about, i.e. the effect of treatment over time, you see that in the low product category, these prices are jumping up and down. There seems to be no rhyme or reason to them. But in the high product category, high drop category, these prices seem to be going up over time. And I think this question needs more exploration, but what I was able to find in my JP was that this was driven, one, in part by Medicare changing the control group's prices to look a little bit more like the treatment groups as the years went on. But this doesn't, one, explain why the low prices keep jumping up and down, and two, even with more advanced fixed effects such as polynomial lines, linear lines, more product market time fixed effects, etc., I was still seeing this kind of weird dynamic effect. And so I thought the next logical conclusion would be perhaps there's some anti-competitive practices going on that are leading to a less effective treatment over time. Unfortunately, both due to time and data constraints, I was unable to find a conclusive answer beyond some evidence that there might be some collusion happening in Florida with respect to nebulizers. However, I think this is definitely an interesting point of further research. So even with this outstanding question of what exactly is driving the heterogeneity, we can see that even with inefficient auction design, the competitive bidding program is very effective across a wide variety of products. However, it's important to note that this competitive bidding is not equally effective across these products, and further research should be done to make sure that this policy is maximally effective across all of these very different yet very important life-saving devices. And so finally, to all the juniors in the room, I was in your seat about a year ago, absolutely petrified as to, what could I write my JP on? And here are a few pieces of advice that I think would have helped me back then. I would say first and foremost is choose your data set thoughtfully. I ended up having to create my own data set, and trying to clean just a lot of Medicare data was immensely painful, to say the least. I also, was FOIA requesting various data to be able to better answer the heterogeneity question. If you know anything about the government and FOIA requests, needless to say, I did not get the data that I requested from the government. And so choose your data set carefully, and ideally, if you can answer a question with an existing data set, that's great. Run your regressions early so you have adequate time to address any interesting anomalies. Don't slack off on your prospectus. Make sure you can just get the most feedback from your advisor as early on as possible. And finally, and this was a piece of advice that Professor Kolazar and Professor Buchholz really emphasized to me, start with an interesting question. Don't go into the process thinking, okay, I have this particular, I want to use a multinomial conditional logit model on this specific data set or whatever. Don't start with the tool that you want to use. Right? Instead, be open, start with a question that you think genuinely has meaning, and then find the tool that works with it. And with that, thank you so much for listening.
So imagine waking up to find out that all the money you worked for, all the crypto assets you've been saving for years have completely evaporated, or they're actually currently evaporating. So you try to, of course, rush in, try to withdraw your money, liquidate your assets, only to find out that everyone else is doing just the same and there's essentially no way out. So what you thought was the promise of an uncharted, decentralized financial system ends up turns into an absolute nightmare. And this is exactly what happened in May of 2022, when the Terra Luna ecosystem collapsed. And this event is actually the base case study for the research I'm going to present today. I'll show you how I ventured into that space to try to understand the phenomenon of bank runs in the decentralized finance space. My name is Antek Hasiura. I'm very grateful to be here, and I had an amazing chance to work with Professor Jonathan Payne to conduct a natural language processing sentiment analysis on the collapse of a major lending protocol on the Terra Luna blockchain called the Anchor protocol. So let me start off by explaining a bit about the background of this research. So that May, in the span of just a few days, a very popular stablecoin called Terra, or UST, stablecoin is a crypto coin that has a value pegged to $1, so it always is supposed to trade on the $1 basis, actually lost that $1 link. And that led, of course, to tremendous loss of value in the Terra Luna ecosystem. And as that was happening, many began to look at the Anchor protocol as one of the leading causes behind this collapse. And Anchor, think about it as like this digital bank in the Terra Luna ecosystem. So you were able to essentially put in your stablecoins, deposit them into the protocol, and you guys have a bit of a graph there on the right-hand side, which explains that. So you're able to put your stablecoins into the system that would then be used to originate loans to others against the collateral in assets like Ethereum, Polkadot, Luna, Atom, and a variety of others. And that was supposed to work great. That was supposed to pay out the deposits pay out an interest to depositors, and worked out well for quite a while. But unfortunately, in early May of 2022, concerns began to grow around how is this protocol actually making money? And some people, particularly in social media, on Twitter, decided to go out and say, this may be a Ponzi scheme. There is no way they're making this much money. Keep in mind they were paying a 20% deposit yield to the people who are paying out their stablecoins. So very attractive at the time. And indeed, a few weeks later, a run on Anchor actually occurred, and the ecosystem collapsed. And I'll just tell you, this system, a lot of people believe this is the future of finance. There was so much venture capital money in it. There's, the biggest venture funds have all invested in this, and they thought this is going to be huge. And unfortunately, in a span of just a few days, this whole thing collapsed. So that's exactly what my research wanted to study. I wanted to see what was the cause behind this collapse. So that leads me to my research question, right? So what was the underlying cause behind the run on the Anchor protocol? And as I started to think about this, I had two leading hypotheses in mind. One is that, perhaps simply the collateral assets that you had, right? All this Ethereum, Atom, Polkadot, many people grew concerned that they're not sufficient to protect the loans that people, that the protocol is actually making. So maybe that scared people off and they withdrew money. Second hypothesis that I thought about, which is perhaps even more interesting, is that I thought maybe there is something about the psychology. Maybe the fact that there was so much fear around, the idea that this may be a Ponzi scheme, maybe that caused the run. So my approach was to actually combine the macroeconomic bank run theory. If you guys have studied the Diamond-Dybvig model, it's a very popular model on the bank runs. Actually, funny enough, when I was doing this research, this model won the Nobel Prize. So that was really cool. I emailed my AI. I was very excited around the time. And I combined that model, so sum game theory, with the tools of machine learning to pinpoint the exact reason as to why the run on Anchor occurred. So the question was there a fundamental flaw, collateral-wise, or was there something about psychology that just caused this irrational fear to materialize and led people to withdraw the money from the protocol? So I'll show you a few bits of data that will help you understand how I set up my model. Firstly, and I know Ashley just said it's not good to build our own data sets. I made all of my own data set, and it was, it's crypto, so it's a bit different, but the data in crypto is actually amazing. You have access to things that you would never get from a traditional finance institution. You can see, for example, net inflow and outflow of all the money that's flowing into the protocol and flowing out, right? So you see this spike around, negative spike, around 2022, where all the deposits, people begin to flee from the Anchor protocol. They grow concerned, and that's the run, right? So as you may expect, that's going to be my Y variable in the regression. I'm trying to predict the volume of withdrawals in the Anchor protocol. And on the X variables, right, first hypothesis, as a reminder, right, drop in collateral value. So what I decided to take a look at is, okay, so what are all the assets that are in the protocol? What is their value over time? And you see this significant drop around, again, May of 2022, where all those collateral assets begin to drop significantly. So that was, again, one of my X variables in the regression. And then that's followed by the Twitter sentiment. That's probably the most interesting part of this research. And that was, of course, way more involved as well. Essentially what I did, I went into Twitter, I collected all the tweets that were relevant to Anchor, to Luna, to Terra, that were around the time period I was exploring, collected all of that data, cleaned it, and I used the natural language processing model. So essentially, you can think about it as I had a database of tweets, I used the model to assign each tweet a probability of what is the positive, negative, or neutral sentiment likeliness of this being assigned to. So you guys can actually see some of the output samples on the top right corner. And below that, I wanted to use that in my regression. So I actually constructed an index for each of the days, right? So I was able to tell what is the overall sentiment on Twitter for the day for Anchor. And you guys can see on the left-hand side where I charted that over time, you see the significant drop in sentiment, which, the day the bank run happens with the purple line that you can see. And then you see the sentiment actually drifting down gradually as the bank run occurs. So that, again, was used to evaluate the hypothesis. Maybe there was a psychological argument for the run. So that's my methodology, just to summarize. It's an OLS regression with the sentiment, Luna, and that Luna I thought of as a proxy for the activity in the broader ecosystem, and ETH, so Ethereum, as the activity in the stablecoin market. So that was the setup of my regression. And here is the result. I'll point you towards the significance of the sentiment index, the Luna price, and ETH, right? If you look at the T-stat, they're all significant. I also point you to the R squared. It's like at 0.3, which is pretty good. I, of course, ran a bunch of different regressions. That's the one I ended up with that had the least issues of cross-correlation and things like that you guys probably will think of when you do your own research. So what's the conclusion from all of this, right? Based on the outcome of this regression, I've concluded that it was both the sentiment shift and the drop in the value of collateral assets that was actually significant in explaining the bank run on Anchor. And I think the most important takeaway and most interesting takeaway from this research is that psychological considerations matter for decentralized finance. And this really calls into question, if you think about the efficient markets, right? Maybe in the context of crypto, there is something special. Maybe there is some data that's actually priced in that's not even public at all. Or there's some private data that's priced into the prices of the collateral. Maybe the data in DeFi propagates much faster because of the reliance on Twitter, right? Maybe the protocols like Anchor and other lending protocols, there's quite a few of them, are actually more likely to undergo a bank run compared to traditional institutions because of that nature of information in digital space. However, it's worth noting that collateral was also important, right? The regression with just sentiment wasn't sufficient enough to tell the whole story. So was there a design flaw in Anchor? Clearly there was. But psychological considerations also matter. I think the interesting thing I'll mention is that there's quite a lot of parallels to the financial crisis, so maybe we haven't learned as much as we thought we've learned from these things. For example, if you think about MBS, and as I talked about the collateral, right? Collateral was one of the reasons why Anchor collapses, right? It's kind of the same reason why mortgage-backed securities collapse, because they give the same sense to people when they buy into those instruments. They think, I'm diversified. I own a ton of different mortgages. Here, I own a ton of different loans backed by crypto. So they give you this false sense of diversification. And as you guys know, in a crisis, all correlations go to 1, and they were generally pretty high in the collateral sense. So that, of course, caused the collapse eventually. So on the policy side, the reason why I wanted to mention this is that most countries actually step away from regulating DeFi, and I think this shows that there's quite a lot of damage that DeFi can cause. So maybe that's something that regulators should consider to think about when they think about regulation. So of course, there's simple stuff like disclosing collateral, disclosing how the yield is generated, because that's really what caused the run at the end of the day. People didn't know how is this protocol making this much money, supposedly, right? So having a clarified disclosure requirement with regards to how do you calculate the APY could be very helpful to protect from the sentiment shifts. And lastly, if you're able to develop a risk management model that takes into account active monitoring of sentiment, you're able to create a very efficient lending system that maybe has some withdrawal suspension schemes in place, depending on how the sentiment is evolving. So with that, in closing, I'd like to thank the Griswold Center. This is an amazing opportunity. Never thought my JP chapter would end in the Lewis Auditorium, so it's an absolute honor. And I think for you guys, for juniors, one thing I'd say, as I think back about my research, I would like you to think about the bold questions that you can ask, right? As you guys can see, my research is very non-standard. If you guys have a niche field of interest, right, maybe combining computer science and econ, this is the time to do it. This is the time to contribute to the scholarly debate. That paid tremendous dividends in my case. So best of luck in your research adventures, and thank you so much.
All right, well, hi everyone. My name is Shirley, and today I'm excited to share with you all my junior paper on the distributional effects of monetary policy shocks in China. So, as we know, central banks have been really under the spotlight in recent years with cycles of easing and then tightening following both the great financial crisis and COVID. I apologize first off that you're stuck here listening to me instead of Chair Powell. As we all know, the Fed just now, about an hour ago, decided to hold interest rates, and I would love to catch up on that afterwards. In any case, although we know monetary policy is a blunt tool not meant to address social issues, there are both intended and unintentional effects of monetary policy on inequality. So in recent years, a lot of scholars as well as policymakers in advanced economies have been looking at this question. However, the connection between the two in China has really been understudied. So we've seen a rise in inequality in China since the country began its economic reforms in the 1980s. And at the same time, the monetary policy regime had also been transitioning from a quantity-based framework where you target the money supply to a more standard rate-based regime like the one in many developed countries, including the US. And so I was curious about if there was any potential connection between the two. Now, the methods to study monetary policy shocks in advanced economies have become quite developed. However, when I looked at the limited literature on China, there are a lot of shortcomings. For example, people making assumptions about the central bank's policy rule, which may or may not hold true in practice, a lack of consideration for potential endogeneity between the policy decision and the macroeconomic environment, as well as looking at aggregate measures of inequality like the Gini coefficient, which really fails to capture the heterogeneity of household experiences. And so what I set out to do was to improve upon techniques used to study monetary policy transmission in China to answer the questions, do monetary policy shocks have an impact on inequality? And if so, can we use the theory of income composition to explain that? So the intuition is that lower income households tend to earn more from labor and business income, whereas higher income households earn more from asset holdings, and their sensitivity to monetary policy shocks may look different. Now, when I was designing my empirical strategy, I had to keep in mind a few things that are particular to China's monetary policy system. One is that unlike the Fed, which has a clear dual mandate, it has multiple objectives, and it also uses a range of different policy tools to target those objectives. And as we all know, it is not politically independent. So, like Antek, I also had to construct my own data series in a way, because when you're working with China, you have to be a bit creative as well. So here I constructed a novel monetary policy shock series, actually. And what this means is that I try to isolate the surprise component in the PBC, or the People's Bank of China's policy rate decision, in every announcement from what can be predicted using macroeconomic indicators. And that's really important to control for, again, the endogeneity between those policy decisions and macroeconomic conditions. So I reviewed a range of literature on developed countries and chose a method called high-frequency identification using external financial instruments. So this basically means looking at the change in a financial instrument that's closely linked to the short rate over a short time window around policy events. So I specifically chose daily changes in the 7-day Chibor rate around 188 monetary policy events. Some of them are changes in the instrument, so in the actual rates, and some of them are just central bank announcements and communications. Now, after I constructed this shock series, I fed that into a structural vector autoregression system, which is a very popular method to study impulse responses of various macroeconomic outcomes in response to monetary policy shocks. So here, YT is essentially a vector of monetary policy shocks, macroeconomic covariates, and the outcome of interest. And then I regress it on lagged variables. And then I apply the right identification on the coefficient matrix to control for contemporaneous relationships between the variables. I learned about VAR in a course taught by Professor Zaidi here, specifically on research tools in Mackerel, if anyone is interested. So I know a lot of you are probably more interested in the micro questions, so I won't go into the methodological details here. But if anyone is interested, I highly encourage you to take the course. So after running those regressions, my results showed that a contractionary monetary policy shock, which I calibrated to be an 100 basis point or a 1% increase in the interest rate, to increase inequality in China by increasing the relative top 1% and top 10% share and decreasing the bottom 50% share of national income. Now, using disposable income by quintile as my outcome of interest, I found similar results, where you have lower income quintiles affected more by the higher quintiles. This actually differs from what people found in developed countries, where you have both the very bottom and top of the income distribution affected more than the middle. And that's typically because you have both labor and asset income responding negatively to monetary policy shocks. So I was curious to see if the same income composition channel can really be applied to China's case. So then I looked at disposable income by source as my outcomes of interest, and I found that indeed labor, business, and property income responded negatively to monetary policy tightening. However, what's interesting is that transfer income didn't seem to show much reaction. So in some developed countries, you actually see transfer income responding positively to monetary policy tightening because it acts as an automatic stabilizer to really offset some of the negative impacts on lower income groups. So perhaps in China, due to a weaker social safety net, we're not able to see this benefit almost from transfer income for the lower income households. And then for the higher income households, I was curious if asset holdings would provide a hedge against negative effects of monetary policy tightening. And so here I use the CSI 300 equity index as well as residential property price index as proxies for asset market returns. And I found that reactions of both asset markets to monetary policy tightening have changed after the country liberalized its interest rate in 2015. Now, overall, monetary policy transmission through asset markets in China is still a topic that's understudied, and I didn't have a lot of time to dig further into this. I'm actually expanding on this in my senior thesis, but essentially what this means is that asset holdings or asset income is not as sensitive to monetary policy shocks in China compared to other countries, which means that there might be some hedging benefits actually to the higher income groups. So overall, I concluded that yes, contractionary monetary policy shocks or an increase in interest rates exacerbate the state of inequality in China, and this can be explained by the income composition theory. There are a couple interesting policy implications we can draw here, especially in light of some recent trends in China's economy. One is that we see both urban and rural household income composition actually change over the past couple decades. And so this may affect how different sources of income would respond to monetary policy shocks in the future. And as a related point, strengthening the social safety net through transfer income may help reduce some of the negative effects on lower income groups. And we also saw household participation in asset markets increase over time. So we saw household holdings of various types of assets, including savings, financial products, and real estate increase. And again, this may have implications because we also know that monetary policy transmission through various asset markets and through the real economy has been changing as China's monetary policy framework continues to evolve. So overall, it was a very interesting topic to study, and I was personally very invested in the topic. I would like to thank my advisor, Professor Payne, and AI Yino Zhang, as well as Professor Wilkins, who is here today, for their support throughout the process. Thank you very much for listening to my presentation.
Hello, everyone. My name is Satchell, and today I will be presenting on my junior paper about how credit supply shocks affects families' ability to move to high opportunity neighborhoods or lower poverty neighborhoods. I'd like to thank my advisor, Professor Adrian Matre. So I kind of came to this project from learning about the research by Raj Chetty, and those are opportunity insights on what they call a causal exposure effect. A causal exposure effect is, think of it like a neighborhood effect of how does a child's future income when they're, say, 26 years old, how's that impacted by where they grew up? So from what Raj Chetty and all find is that child's future outcomes aren't just based on the fact that, say, a child is smarter than another child. It's that the effects of living in a certain neighborhood have important effects in the future. And so you can think that the neighborhood that you grow up in is really important in your future income and not just somebody's own inherent abilities. And so I want to take this idea and pair it with something I learned in one of my courses here about the financial crisis and how people have access to a home mortgage. And so when people want to buy a home, they need to take a loan out from the bank. And so I wanted to study how these changes in the credit supply of loans people can take out to buy a mortgage would impact their ability to move to a new area, or an area that might have a certain higher causal exposure effect, or it might be an area where there might be better schools, or whatever it might mean that children can have a better future outcome based on wherever they're living. So this does lead me to my research question, which was, if there are changes in the credit supply for buying homes, do these changes in the credit supply cause people to move from counties with less economic opportunity to counties with rates of higher economic opportunity or opportunity zones? So you might think that whenever there's a shock in the credit supply, so banks have more money to give people to buy a loan so they can buy a home, where are people choosing to buy this home? Do they now have the opportunity to buy a home in an area that might be considered an opportunity zone? It might be an area in lower poverty. And so a part of my hypothesis was with this paper was I honestly wasn't sure that I would get statistically significant results. I think when you think about where your parents just maybe buy their homes, there's a lot of factors that go into this. It might not just be that a bank has more money to give a loan. It might be the social factors of where their friends are and so many other things. However, I was interested in some of these broader questions about economic inequality and the ability to move to an area of higher economic opportunity. So in contrast with some of the other presenters, I did not build my own data set at all. I instead I built my paper on another paper by Favar and Ims. So Favar and Ims study the Interstate Banking and Branching Act of 1994, which was an act that allowed states to increase the number of banks in those states that could give loans. So it's an exogenous shock in the credit supply. So in 1994, Favar and Ims show that in 1994, there's a major increase in the credit supply, so there are more people that could take out a loan to buy a home. And in their paper, they show that when you increase the credit supply, this is a catalyst for an increase in home prices. And this was kind of the starting point of my paper. And in their paper, they also provide a publicly available data set, which includes various informations about home prices, population changes, as well as a measure of a deregulation form. A key component of my analysis is a marginal effect, so the impact of credit supply given that you're coming from a county with a higher or lower poverty rate. So in this sense, I took data from the census, or the American Community Survey, on poverty rates in counties across the country. And so importantly, I'll note, as you'll see later, I break up my national data set. I then, by state, I group counties by quartile. So if you take the state of New Jersey and you rank all the counties with the highest poverty counties at the top and the lowest poverty counties at the bottom, Q4 would be the counties with the highest poverty rate, Q1 would be the counties with the lowest poverty rate. This is just, I note this now just because this is in opposition to income. When you think of a high income quartile, that's Q4, where in my situation, high poverty quartile is the highest rate of poverty. Finally, another relationship I wanted to exploit was this relationship between neighborhood effects and poverty. Part of my hypothesis was the sense that areas that are characterized as opportunity zones also potentially have lower poverty. If you're thinking about buying a home, you might want to buy it in an area that has various resources that can help your children excel in the future. And I wanted to see the relationship between these areas of high opportunity and the poverty rates in those counties. So through these various forms of these 3 different data sets, I created a nationwide panel data set from 1994 to 2005 on these various factors. And I first just wanted to replicate the results from Favar and Ims. And so in their paper, as I mentioned, they show that deregulation and credit supply is a catalyst for a change in home prices. So this first regression that you see here, it has The D variable is the input of a level of deregulation. So if a state decided to pass deregulation, such as New Jersey, and there's an increase in number of banks that are allowed to give homes for people, that are allowed to give loans for people to buy a home, how does that affect the home prices in that state and the counties in that state? Secondly, I wanted to exploit the effects, the causal exposure effects, and how does that affect the poverty rate in a certain county. So I also study this for families that come from the lowest quartile and families that come from the highest quartile, as later on I'll use causal exposure effect as a certain control in my regressions. So the third set of regressions are my key regressions from my paper. To build on the model again that Favar and Ims built, credit supply is not directly in this regression as you see here. Deregulation is the catalyst for the credit supply. And I also, through replicating the results from Favar and Ims, I'm able to use deregulation as a form of instrumental variable for the change in home prices. And so what the second regression is indicating is, say you're in New Jersey and New Jersey chose to increase deregulation. And so there's more banks that can provide loans to people. If you're from a certain county with a certain level of poverty rate, say you're in a high poverty county, what happens to the migration rate of people in and out of that county? And so I'll do this for all 4 quartiles of the poverty rate as well as just a continuous variable. Finally, my last set of regressions was also building on what Favar and Ims studied, as they both studied the price of homes as well as the supply of homes. As you can think, if there's more loans to provide for people to buy a home, there also might be more loans for developers or contractors to maybe build developments, and this might change the supply of housing. And so I also build on their paper and add this marginal effect of the poverty rate to the results from Favar and Ims. So these first 2 tables are replicating and providing the results from the first 2 regressions I showed you. Importantly, I find the exact same results as Favar and Ims, and I see that in a state that increased the level of deregulation, and so there's more credit supply, there's more loans for people to take out and buy homes with, there's a 1.04% increase in the home price growth rate in that county. Secondly, I also find that there is a statistically significant relationship between causal exposure effect and the poverty rate of a county, and in a place with a higher causal exposure effect, meaning that it's a place where there's more resources for children to have better outcomes in the future. Those are also places with lower poverty rates. So this adds to the motivation that people might be more willing to buy a home and move to an area with a lower poverty rate. So this is a table of the primary results of my paper. And if you look in column 4, you see that in a state such as New Jersey, say, which had deregulation, if we hold the increase in deregulation constant, in a county with a low poverty rate, there's an increase in the number of people that move there when there is a greater credit supply and when people could buy homes, when there's greater access to buy homes in that new county. And there's a decrease in the population in counties that had higher poverty rates, or Q4. And so this is exploiting some of that shock in the credit supply and how that might affect people's ability to move to and from higher or lower poverty neighborhoods. So some limitations to this are there's a large literature on how the credit supply does depend on the price of assets. And similarly, as Favar and Ims point out, there's also a certain issue as the states that we saw that have higher levels of deregulation are typically states where there's greater political power on the behalf of banks to pass those forces of deregulation. And typically those are states that are coastal states like California, New York, and New Jersey, which as you might know have very high home prices. Also, I think one thing I think that's very important to note is my data was at a county level, so I have data only on the county migration rates. I don't have information at a very micro level on this family was able to take out a loan and this family was able to move to the certain county. I'm grateful that I was able to get certain statistically significant results and was able to draw a certain causal link at a county level. However, I think there is a lot more room for research to be done on people who are from higher poverty neighborhoods getting access to home loans and becoming first-time home buyers or being able to move to areas of higher economic opportunity. I think there's also a lot of room for research with regards to rents and access to affordable housing in the same research as people are trying to understand the issues related to wealth inequality and such in this country. And I'd like to thank you so much for listening to my presentation.
Hi, everybody. My name is Nicole, and today I will be discussing my JP, where I examined the effect of hurricanes on the Florida housing market in varying flood vulnerability zones. I would like to take this time to thank Professor Swati Bhatt for her time and comments, so thank you. Alrighty, so brief introduction. I am born and raised in South Florida, and Florida is the most hurricane-prone state in all of the U.S. The housing market is one of the most affected areas after a hurricane due to significant property damage. So I noticed two strange things occurring simultaneously when I was home. The first is I looked around me and I saw that home values were appreciating, as you can see on the graph, relative to homes in the rest of the US pretty rapidly. And another thing I noticed while walking around Miami is the amount of construction projects I saw along the coast. Additionally, simultaneously, I also noticed more evidence coming up about how rising sea levels would be affecting Florida and coastal cities, especially places like Miami, where the elevation is only 6 feet above sea level. Additionally, I saw reports about how the severity of hurricanes would be increasing. So this really puzzled me because why would people be moving to a state such as Florida if its environmental risk is going to be increasing in the coming years? And why are people willing to pay so much for homes here? So my larger motivation for the project was to try to gain insight as to how the Florida housing market incorporated environmental risk, if at all. And with this information, I hope to provide some guidance to future climate policy and hopefully mitigate a future housing crisis. So overall, from my motivation, my research question became, what is the effect of hurricanes on housing prices in Florida across zip codes of varying flood risk levels? So just to talk for a second about how I jumped from my motivation to my more specific research question, by looking at the effect of hurricanes on housing prices, hurricanes serve as a reminder of risk to residents in Florida. And by observing how this risk was perceived in zip codes of high risk level versus low risk level, I hope to get an indication of how these homes were already taking this risk into account. So, literature review. Surprisingly, there's a decent amount of literature on the effect of hurricanes on the housing market. However, it is conflicting. So some studies concur that the price of homes increases after a hurricane due to a supply shock. Some properties damaged, so there are fewer homes standing. Thus, the price of these homes increases. And other studies concluded that the price of homes would decrease after a hurricane, and this is due to the fact that there is increased risk perception. Residents are more aware of the risk, thus prices drop. So on this front, I expected prices to drop after a hurricane. I found these arguments more compelling. And as for how risk is incorporated into this, so I hypothesized, my logic was if risk was accounted in these high risk versus low risk zones, then there would be a smaller drop in housing prices in the high risk zip codes. And this is because residents that lived in these high risk areas were aware of their risk, and the hurricane served, it wasn't as much of a shock when a hurricane came. This was something they anticipated, while residents that lived in lower flood risk areas, the hurricane, it was a greater shock. They weren't anticipating as much, thus the prices dropped more. I anticipated that Florida, I did not think it properly took into account environmental risk, so I hypothesized that the drop in housing prices would be pretty equal across the high-risk zip codes and also the low-risk zip codes, and the hurricane would serve as an equal shock to residents across these different areas. So for my dependent variable, I was looking at home prices. I used data from Zillow's Home Value Index at a zip code level. So I looked at the typical home price per zip code, and this data was updated each month. For my independent variables, for my metric to gauge environmental risk, I used the Federal Emergency Management Agency's National Flood Hazard Layer, which you can see are the top 2 photos of those flood maps overlaid on a map of Florida. And I calculated this metric myself. I added up all the little areas of high risk labeled territory within a zip code, and I calculated the percent of the zip code that is covered in this high risk territory. I used 3 different hurricanes, Charley, Wilma, and Michael. I chose these based on the fact they're all considered major hurricanes, meaning they're category 3 or higher. They all span different regions of Florida, so that would provide some more variability. And additionally, they struck at different times. So I thought if the trend could hold over these 3 different hurricanes, it would provide some more validity to my results. Methodology-wise, I used a difference in differences approach. And the reason why I chose this is because I have some zip codes which are exposed to a treatment being the hurricane struck them, and I had other zip codes which were not struck by the hurricane. And I wanted to estimate the effect of the hurricane on these housing prices across varying flood risk levels. Out of this equation, the 2 variables which are most pertinent to the answers that I want, I have treated interacted with post, which I'll also be referring to as the DID variable or difference in differences variable, and treated interacted with post interacted with risk. So the treated interacted with post, the DID, that variable tells us, okay, so after the hurricane strikes these zip codes, do housing prices increase or decrease, and how much? And then the DID interacted with risk variable is telling us, okay, now how does that vary across zip codes of low risk versus high flood risk? So that is the variable I'm most concerned with for my question. So this is the first round of results. I have 4 equations up here, as you can see. So for equation 1, I did it on all 3 hurricanes combined, so it serves as an event study, slightly less accurate because it assumes they're all the same magnitude, but it provides an overall trend. And for hurricanes 2 to 4, I ran it on the hurricanes individually, so you can see I have Charley, Wilma, and Michael. And the first thing to notice is for DID, we can see 3 out of the 4 are statistically significant, and overall, it's showing that housing prices seem to decrease after a hurricane. And for DID interacted with risk, only one of these equations produces a statistically significant result for Hurricane Charley. And here we can see that it seems that homes in risky areas seem to decrease by $171,000 less than homes in non-risky areas. I know that was a little bit of a mouthful, but basically it's showing there's a smaller drop in price in homes in risky areas than homes in non or less risky areas. I wanted to see if there's a way I could produce more statistically significant results for the DID interacted with risk, since that is what would answer my question the most. So I decided to try to run the results again, but this time using a quantile regression. And basically what that does, it allows us to drop the assumption that least expensive homes and the most expensive homes operate the same way, or that the hurricane affects these different priced homes equally or the same. So I tried again, and luckily I did find some more statistically significant results, even though it's fine if you don't in your paper. But anyway, so for DID, we can see the trend persists of, it seems the home prices drop after a hurricane. So it's nice that there's some more confirmation to that. And then as for DID interacted with risk, we can see that a lot more statistically significant results, and overall it is showing the same trend, that it seems the homes in the more risky areas seem to drop by a smaller amount than homes in less risky areas. And slight tangent, but something I found interesting, is I was curious what caused this difference in the hurricanes. Why did some zip codes, counties seem to account for the environmental risk more, while some less? So as you can see here, I plotted the 3 hurricanes over the Florida electoral map. We can see that Wilma crossed some more left-leaning counties, and Michael, all the way up the panhandle, crossing the more right-leaning counties. And I found it interesting that it lined up with how much these zip codes and counties did account for environmental risk. Wilma accounted for environmental risk the most, as opposed to Michael, which did the least. And it semi-lines up with the way these counties decided to vote. So of course this needs more research, but I found it interesting, so could be interesting grounds for further research. Overall, my conclusion, so I did find that home prices did drop after a hurricane, and that the prices of homes in higher risk areas drop by a smaller amount than homes located in lower risk areas. There are a few different possible explanations for this. One, hopefully, I hope that residents in these high-risk areas were aware of their environmental risk. They took this into account, so when the hurricane came, they weren't as surprised. However, another possible explanation could be that the homes located in these areas of higher risk were just built better, so there was less damage afterwards, and that's why their prices didn't drop as much. Now, from my research, there's no way to tell exactly what the cause of this was, but once again, interesting grounds for more research. And I think another thing that could be incorporated is looking at more hurricanes as opposed to just the 3 that I did. So implications is housing is often overlooked when you think of climate change, but it's really important. Overall, climate-fueled disasters are actually the primary cause for internal displacement, and this typically affects marginalized communities the most. Post-disaster build reconstruction tends to favor the elite and privatization, so being conscious and thinking about these effects beforehand is really important in order to ensure equality and affordable housing for all. So I hope that to continue some research on this and get some more answers. But overall for advice, first is put your data in Stata early. I was here last year and somebody told me, make sure you have a data set. So I did that. I found a website with the data. I was like, cool, I'm good to go. That's all I need. Turns out there's a big difference between just finding a website with the data and actually having it in Stata. I had to go to a special computer in the Geospatial Information Center, became best friends with the librarian there, which is great, but it took a lot of time. Also run your summary statistics early on to sanity check. If you're calculating some of your own metrics like I did for the flood risk level of the different zip codes, it's important to just run these early on to make sure you're catching mistakes early. I caught a mistake somewhat late on, was able to fix it, but I was panicking for a little bit. And also take the time to find something you're interested in. This is something that I really wanted to know more about, so it was pretty enjoyable for me to work on, and I was really curious myself. So I would take the time early on to find something that you can actually see yourself devoting this year to. And lastly, ask for help early on. There are so many resources, so just don't be scared to ask for help. And that is it for me. Oh, wait. Okay, anyways, that's it. So thank you.
So thank you again to our speakers. I thought that was fantastic. So now we have a chance for Q&A. We're going to leave some good advice, timeless JP advice, up there on the slides. But if we could have some questions either about the content of the talk or about the JIW JP process in general.
Just also wanted to thank all four speakers for just terrific presentations, really impressive. 5 speakers, terrific presentations, really impressive. I had a couple of questions, one for Shirley and one for Antek. Shirley, I wondered when you're looking at the distributional effects of monetary policy in China, have you also thought about demand-side channels that could lead to distributional effects? So, for example, as inflation moves across the business cycle, rich and poor people may be differentially affected because of the types of products they consume. So particularly evident in the Russia-Ukraine war, which primarily drove inflation through higher food prices, which are a bigger share of consumption for low-income consumers. So the central bank would respond to that is going to have uneven effects on the demand side. And I wonder whether that was relevant in China or whether it wasn't important. And then just quickly for Antek, very interesting as well. I guess bank runs are a generic feature of banking or any form of finance. And for more conventional banks, the central bank typically has a lender of last resort commitment, which helps to stem bank runs. Whereas for the Anchor protocol and DeFi more generally, the central bank doesn't really extend the same lender of last resort, perhaps maybe because it thinks that bit of the financial sector is less embedded in the macroeconomy, and so the macro implications could be less severe. I wonder whether that's something you thought about as well, but really difficult fight presentations.
Specifically for this project, I focused on income inequality, but I do believe that this is a relevant question for sure, and especially as China is figuring out how to really get itself out of the current economic slowdown. So my personal view, I guess, just on the topic is that for a long time, I think China's monetary policy, because it had so many different objectives and because the country was more focused on this investment-driven economy, I suspect that the PBC actually didn't really consider consumption as a big part of its policy making. It was controlling more so the credit supply and stimulating the economy through infrastructure investment, for example. Now, in recent years, with the new Common Prosperity Objective and also with China's economy really struggling, being so over-leveraged, and I think it's unable to further stimulate through infrastructure, I do think it would be really interesting to look at whether or not monetary policy might be taking into account the heterogeneous effects on household consumption. Yeah, thank you very much for the question. I'm personally really interested in that as well.
Awesome, and thank you for the question here as well. So something that exactly towards the end of my paper, I wrote about this a little bit, because this is how we resolve the issue of, well, I guess sort of resolve the issue of bank runs to an extent in traditional finance. So look, if there was a way to do that, I think there's probably a way in which you could make those bank runs less likely. But as you said yourself, right, it's very unlikely that any centralized body from a government will be willing to step into DeFi and protect them. That's actually part of the reason why what I talked about towards the end, which is if we're able to build better risk management models with regards to, for example, sentiment, maybe that's a way in which we can overcome the fact that deposit insurance is rather unlikely to operate in the case of DeFi.
Any other questions?
Thank you all. I had a question for Antek. I was wondering, for the psychological side of things, how did you balance your time between econ research and psych research?
Yeah, no, that's a good question, right? Because my GP kind of falls in between a lot of different things. So there was a bit more econ in it than I showed in the paper in the presentation now. I did use a good amount of game theory, so I think the main part of your research should still be within econ. So there's a lot of game theory in my research. There's of course the regression, so econometric stuff. But I think the way to think about it is that you can use the frameworks of econ and supplement them with tools from the other disciplines. And I think that's how you can actually make something that's really interesting. And that's how I thought about my research. So, it is primarily still econ theory, but just use the tools to get, some of the interesting data and some of the thoughts to supplement that. So, but you're definitely, very much able, and I think the department seems to be very supportive of this, of combining the disciplines together.
Yeah, as a I can say that if you're using data and using econometric techniques, topics really can be, they could be sociology, they could be psych, econ. For better or for worse, econ has sort of, reached its tentacles into lots of other fields, maybe not so much maybe to the chagrin of those fields, but we would be very unlikely to say, oh, you're using data and econometrics, but the topic itself is not econ enough. That is not really how we think about the GIW. So if you're using the tools of econ, I think you're in pretty good shape. Some of the certificate programs sometimes want you to use a certain amount of, maybe this is more from senior thesis, or other, a certain part of it has to use other, finance or whatnot. But the econ side tends to be pretty flexible so long as you're using, data and econometrics or econ theory. Max,
I can just speak really loud. I just wanted to ask a question to all the panelists. How many hours a week would you say you spent on your JP?
On average, or like?
We'll say first semester average, and then second semester average.
I don't know if I'm an exemplar person to speak about not procrastinating on your JP. I would say my prospectus was not that great. I didn't spend the time I should have, I think, building up the motivation, the methods behind my question. But I would say about the month before the JP was due, the hours really started piling up. So I would say, maybe the first semester I was spending less than 2 hours a week on my JP, but in the second semester that almost went up exponentially. And you just shouldn't procrastinate on your JP, and don't do what I did.
Agreed. I think first semester, I second that I probably was under 2 hours each week. Second semester, that of course changed. I think I had a meeting set up with the Econ Statistical Services every single day for the last 2 weeks for half an hour. And I think the last 3 weeks, maybe I spent 7 hours a day. So I really, really ramped it up. But before that, not too much. But don't do that. Don't do that.
I do have to say I was kind of the opposite. I do have to say. I think partially I had a slightly lighter course load in the fall, so I feel like in the fall I spent about the same amount of time as I would for like an econ course on my prospectus. And I will say it was really helpful because I can tell you now I think I changed some of my methodology from my prospectus to my JP, but like my intro and my lit review, which is like a third, if not more, of the pages, I remember I think I might have just copied and pasted from my prospectus, and it meant that in the spring I maybe spent like 2 to 3 hours a week on it. And so I really, I remember I fully changed my methodology and like changed the data set as well, as I didn't get one of the data sets, like the most important one, until maybe like February or something. But because I did a lot of the work and the thinking about my project in the fall, I actually did not have that much work to do in the spring. So I can't say really, I remember people at this last year said, focus on your prospectus, and I do think it really did pay off.
It makes it much less stressful if you do more in the first semester. It gets very, very stressful otherwise. So be kind to yourself and put some work in the first semester.
You also get a lot more support because the last 2 weeks before the deadline, it might be really difficult to get like everybody metrics. Everybody is going crazy. So if you go early, you get a lot much more.
Yeah, I mean, I agree with everything that was said. I will just very briefly think about it like a class in your schedule. I think that's the best way to do it. I was also pretty systematic, and that helped me, so I didn't have to, do everything in the last minute. So just think about it like a class. Assign some time to do it over time. Just don't do everything in the last week. I agree with everything that was said.
Yes, similar here. I would say I spent a lot more time kind of in the fall semester or the first half. So my prospectus was closer to a draft, and my draft was pretty much my final version. And part of it was also because I was working with China, and I was really scared I wasn't going to get the right data sets. I was scared my methodology wouldn't work. So I spent a lot of time just looking at the data and methodology. I think it might depend a little bit on your topic, but there's never a downside to starting early. Also, if you want to reach out to other people to get their feedback or even consult authors of other papers, whatnot, you might want to do that early because it always takes time to coordinate these things.
I want to say as a JP advisor for a long time, a good perspective means the paper writes itself in the spring. You really want to treat that prospectus as a final paper, and then you can really have the normal spring.
And you get a lot of feedback on
You
your
get
prospectus. If you write a good one, your advisor is definitely reading it and giving you feedback. So it's a great way to get a lot of information about what's expected of you in the spring. You do it in draft,
Yeah.
so you get feedback, and it makes it that much harder in the spring too.
Totally true. The other thing I wanted to note is, I think there's sometimes like a fear which is unfounded that like if you don't get significant results, it somehow means you're not going to get a good grade. That is a terrible way to think about doing any kind of research. It's bad science, as you would say. I get that maybe personally at some level it might have been more fun to write up, a paper that has stars in the tables, but that is not at all go into your grade. I mean, your grade is how you write up those results, how you interpret them, how much does the data, is the data appropriate for the question, and whether there are 1 star or 2 stars or no stars is irrelevant to your final grade.
Just one last comment on the prospectus. I just want to make sure it's very clear that for your prospectus, you don't have to have regressions run. We do expect you to have identified data and maybe have like a table of means in there. We want to know that you have the data available to answer your question.
That it's in data. I forget somebody.
Yes, in data. I just can't run means without data.
Yes, exactly.
But I get every year, I can't tell you how many students who end up submitting late and you get penalized for it because you're trying to provide regression results in your prospectus. That doesn't really help your prospectus grade, right? And so all you've done is lower your prospectus grade because now you didn't turn it in on time. So remember, you do not need that. You do need data, but it's not useful model to run your results in that prospectus. In fact,